All right, let's spend a minute talking a little bit about the tax forms that are involved. Income tax forms that you should know about. Number one, the 1040. This is the individual tax return. That's what you use to report all of the income the decedent earned up until the date that they passed. As you know, income taxes are owed on a calendar year basis. So we count all of the income in one calendar year. So if they lived from January 1st of a calendar year until whatever date, we take that amount of income that they earned between the first of the year and the date that they passed, and that's what goes on the Form 1040. As soon as the person passes, an estate is opened, and the assets that they owned before they died are now part of their estate. That could be their bank accounts, maybe a piece of real estate that somebody was paying rent on. And the income that's earned by those assets after the person passes, well, that income is taxed to the estate. The income that an estate earns is taxed at estate income tax rates, which is really high. This differs from the value of the asset itself. We're talking about the income that the asset earns gets reported on 1041. And because the brackets are compressed, and by compressed, I mean you easily get to the 37% income tax bracket for federal taxes, plus there's state income taxes. You just want to be careful and distribute as much of the income as possible to beneficiaries so that you avoid trapping that income inside of those high tax brackets. When you distribute the income to beneficiaries, they pay the taxes on it at their own income tax rates. And then the gift and estate tax forms, you don't know the names of the forms, but you know that they exist. You know that you have to fill out a gift tax return during your lifetime on any taxable gifts. That form is number 709. And oddly, even though it's filled out later, the estate tax return is 706. I don't know why that number's not higher. It should be. Anyhow, so the estate tax return that you fill out at death is 706. That represents the value of the assets that you own. Remember, it's the fair market value on the date that you die, unless you use an alternate valuation date, which we'll talk about in a minute. It also includes your lifetime gifts, because remember, we add those two together to come up with how much you gave away during your lifetime, plus what the pile you were sitting on top of when you died. So those are the tax forms you need to know. So now let's talk a little bit about that valuation. First of all, we're looking at fair market value, which is the value that would be paid for the property in a normal arm's length transaction. If an estate is small, if they can, they're going to err on the side of overestimating the value of the asset because they're not worried about paying estate taxes, and they want to give the ultimate beneficiary the higher cost basis if possible. Now, not all assets get a step up, but those assets that get a step up, a small estate is going to be incentivized to overestimate the value, while a large estate is going to tend to underestimate the value of the assets because, of course, they don't want to pay more in estate tax. So now you have to figure out, well, what's the right valuation date? So the valuation date that you choose can either be date of death or the alternate valuation date 6 months later. Because what if this stock that makes up the majority of a decedent's estate, is worth a fortune on the date that they die, but then 6 months later the market collapses, and you're like, wait a minute, I paid estate taxes on that overvalued asset? That's not fair. So you get the choice of using either the date of death or the alternate valuation date. Now, to be eligible to use that alternate valuation date, 2 conditions must be met. 1, the value of assets included in the gross estate 6 months after the decedent dies must be lower than the value of the assets on the date of death. And 2, there must be a reduction in the total estate tax due as a result. So again, this is where small estates are edged out of being able to use this alternate valuation date to get a nice step up. That's not the purpose of the alternate valuation date. It's to give estates that have an estate tax the opportunity to reduce it if the fair market value of the assets drop 6 months later. Now, there are some exceptions within, let's say, you've got this alternate valuation date that you want to use. You're like, hey, I totally want to use this, but we have this estate and it was made up of, let's say, a house, and it also had cash, patents, and it had Apple stock. And let's say between the date of death and the alternate valuation date 6 months later, the executor sold the house 3 months in for $30,000. It was a small house. And the cash didn't change. We had $60,000 here. We have $60,000 at the 6 month mark. And the patents were worth $40 at the date of death. And let's say they were worth $30 6 months later. And Apple stock went from $100,000 down to $50,000. So if these were the actual fair market value at the 6 month mark, what would we use for an alternate valuation? Well, let's talk about each of these. Let's start with the house. One of the exceptions to how you're going to value assets, if you're going to choose to use the alternate valuation date, is if you sold it, we're going to use the value that you got at the time of the sale. So with this house, the alternate valuation is $30,000. Cash, no shock there, $60,000. It was $60,000 originally, it's $60,000 now. Now, how about that patent? Since it's a wasting asset, and what we mean by that is it's an asset that naturally reduces in value. Now, this could include other things besides, patents. The book lists them out. It includes like annuities, royalties, installment notes, etc. So we're not going to reduce the patent's value. We're going to keep that at $40,000. In this Apple stock, ding, 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 we get the 50. So on the original date of death, the estate with the house, original value of $30,000. Again, we weren't assuming they made any gains when they sold it a few months later. Cash of $60,000, patents of $40,000, Apple stock of $100,000, $230,000. Versus the alternate valuation date value, $180,000. So in this simple example, I've violated the principle that in order to use the alternate valuation date, there must be a reduction in the total estate tax due as a result of the election. And with an estate this small, there'd be no tax. But you understand my point, I hope. And if the alternate valuation date value is lower than the value of the estate on the date of death, then you've passed the first bar. The second bar being it must reduce estate tax. So if you don't have an estate tax bill, then you're not going to worry about the alternate valuation date. Now, there's one other opportunity to affect valuation of an asset. You can imagine a scenario where, and the book uses this, a farmer who lives right on the edge of a booming metropolis, but maybe they've had their farm there for, it's been in the family for 100 years. And it wasn't always like on the edge of a booming metropolis. It used to be out in the middle of nowhere. Now, using it as farmland has one value. Using it as property to be developed has another value. And so one of the options is to use this special use valuation. This is the IRC section 2032A. This only works for real estate. So if an individual is using that piece of real estate as a farm or in another business that's not employing the property in its highest and best use, then, so in a nutshell, we're worried about like handing a farm family a big tax bill for their super valuable piece of land, which they're not currently enjoying the benefit of. So farmers aren't making much. They could make a lot more if they sold out to a property developer. But the point here is if the family wants to continue to use it as a farm, we don't want to kick them off. Of course, they could sell it upon the death of the owner of the land. But of course, there's all sorts of problems with that potentially. You're not going to get as much money if you've got to sell it quickly. This special use valuation is intended to provide some relief in cases like that. But there's a limit to how much you can reduce its value compared to what its fair market value would be in its highest and best use. Now, in order to get that valuation, be able to use it, the decedent must have been a U.S. citizen. The property has to be used in a farming operation or in a trade or business that was managed by the decedent or their family for 5 out of 8 years. I mean, you can read all of the rules on this on page 490. But the big rule that usually makes it difficult for people to elect this is the heirs must continue to use that property in its qualified use as outlined in the election for a period of at least 10 years following the decedent's death. So if they don't want to keep running this business or the farm for 10 years, then they're not going to be able to use that election. So there's another scenario where a closely held business might run into trouble or might create problems from an estate tax standpoint. When we talk about closely held businesses, this could include farms. So Section 6166 allows you to elect to make installment payments of the estate taxes you owe. At least those estate taxes that are tied to that closely held business. So, as you'll recall, you got 9 months after the date of death to pay any estate taxes that are due. And of course, if all of your wealth is tied up in this asset that's illiquid, it might be very difficult for you to make that happen. It might be hard to make that payment 9 months later without creating a hardship. So the 6166 allows you to extend it for up to 14 years. So to qualify, 3 things have to be met. Number 1, the value of the business interest must exceed 35% of the value of the decedent's adjusted gross estate. Number 2, the business interest must be a closely held business, a sole proprietorship, a partnership, blah, blah, blah. And 3, the entity must have been actively engaged in the conduct of a trade or business at the date of the decedent's death. Don't worry about all of the interest rate gobbledygook. Just remember that you have the opportunity to potentially drag out the payment of estate taxes over a 14-year period as long as these conditions are met. Now, another maneuver that can be done as part of the postmortem planning is to have a beneficiary disclaim a gift or a bequest. And you might do this if you're the spouse of the decedent and perhaps you already have, you've received all of the assets that you want, and as part of the planning process, you've just decided you would rather disclaim that asset and have it go directly to somebody else so that you don't have to have it in your estate upon your death. So it's not a gift from you. It's essentially just bounced right off of you and went to the next person. So more on disclaimers is outlined on page 491.